Ever feel like your money just vanishes? You track what comes in and what goes out, but you're still in the dark about where it's really going. What if you could use a 500-year-old system that pros use for a crystal-clear financial picture? In the next few minutes, I'll show you how double-entry accounting works. It's not just for mega corporations. It's a powerful tool for your small business, side hustle, or even your personal budget. Section 1. What is double-entry accounting? At its heart, double entry means every transaction is recorded in at least two places. For every debit, there must be a matching credit. This creates a self-balancing system, like a perfectly level seesaw. If you add weight to one side, a debit, you must add the same weight to the other, a credit, to keep it level. This dual effect is what gives you a full 3D view of your finances, unlike a simple money in, money out list. First documented in the 1400s by Luca Pacioli, the father of accounting, its principles are still the gold standard for accuracy today. Section 2. The core foundation, the accounting equation. Everything is built on one formula: assets = liabilities equity. Assets are valuable things you own: cash, inventory, equipment. Liabilities are what you owe: loans, credit card balances. Equity is what's left for the owner after paying all debts. It's the true net worth of the business. What you own, what you owe to others, what you own yourself. Every transaction must keep this equation balanced. If it isn't, the system signals that something is wrong. Section 3. The language of accounting, debits and credits. Forget what your bank statement says. In accounting, debit simply means left, and credit simply means right. We use a T account to visualize this. The account name is on top, debits are recorded on the left, and credits go on the right. Whether a debit or credit increases or decreases an account depends on the account type. Section 4. The 5 account types and the rules. There are 5 account types: assets, liabilities, equity, income or revenue, and expenses. To remember the rules for them, just memorize this phrase: dead click. Debits increase expenses, assets, and drawings. Expenses, costs like rent or salaries. To increase an expense, you debit it. Assets, things you own like cash. To increase an asset, you debit it. Money an owner takes out. To increase drawings, you debit it. Credits increase liabilities, income, and capital. Liabilities, debts you owe. To increase a liability, you credit it. Income, money you earn from sales. To increase income, you credit it. Capital, the owner's investment. To increase capital, you credit it. If you remember dead click, you've mastered the core rule of accounting. Section 5. Putting it all together. Examples. Let's see it in action. Example 1. You invest $10,000 of your own money into the business. Entry: debit cash and asset for $10,000 and credit owner's capital, equity for $10,000. Balance: assets are up $10K and equity is up $10K. Assets = liabilities equity. It balances. Example 2. You buy a company laptop for $1,500 with cash. Entry: debit equipment, an asset, for $1,500, and credit cash, also an asset, for $500. Balance: You increased one asset, equipment, and decreased another, cash. The total asset value is unchanged, so the equation stays balanced. Example 3. You pay $1,200 for monthly rent. Entry: debit rent expense for $1,200 and credit cash, an asset, for $1,200. Balance: your assets cash are down $1,200. An expense reduces your profit, which lowers your equity. So equity is also down $1,200. It balances. Section 6. Why this matters for you. This system isn't just for bean counters. It error-proofs your books. If debits don't equal credits, you know you made a mistake. It's the engine that creates essential financial reports, like the balance sheet and income statement. Most importantly, it gives you the confidence to make smart decisions, apply for loans, and file taxes, because you have a complete, logical record of everything. If this video helped you understand double entry accounting, hit that like button to help others find it, and subscribe for more simple breakdowns of complex business topics. Question of the day: what financial concept still confuses you? Let me know in the comments. Double entry accounting isn't a secret code. It's an elegant system built on assets, liabilities, plus equity. By using DeadClick, you can learn to speak the language of finance, gain true financial literacy, and take confident control of your future. Thanks for watching.